Hello investors, welcome back to another video. Today we're going to talk about the yellow metal, gold. Gold has a special place in this world. Back in 700 BC, gold was first used as a form of currency, but it was not quite efficient as we thought it would be, and was also difficult to carry around. So, the US government, along with a few other countries, used it as a standard to back the paper currency known as gold standard. But the monetary system of gold standard failed tremendously, and on August 15, 1971, the United States announced that they would no longer use gold standard as their monetary system. Despite all that, today, the central banks all over the world still holds about 1/5 of the total gold reserve in their vaults. Some people hold it as jewelry or a status symbol, while others hold it for investment purposes. Many financial advisors also recommend having a certain portion of your wealth invested in gold. But is that really necessary? Is investing in gold really a hedge against inflation? Well, let's find out. Before we dive into the details, smash that like button so that the videos will reach to a broader audience. And also, subscribe to our channel to get notifications while we post a new video. Let's get started. First of all, gold doesn't have an intrinsic value. It's just a piece of metal. It doesn't produce any cash flow, so its value is completely determined by supply and demand. It is also considered an effective hedge against inflation, as it has traditionally beaten inflation and appreciated in value during economic downturns. As you all know, the buying power of paper money decreases over time, and there's a strong correlation between inflation and gold prices. In short, higher the inflation, higher the value of gold. Now, let's go back in time and analyze how gold has performed compared to other assets. In 1990, 1 ounce of gold was trading at $383 on average. So if you had 1 ounce of gold in 1990 and sell it today, you would get approximately $1,856, which is the average price of gold per ounce in 2021. That's a 5.69% compounded growth rate over 30 years. For the same period, the S&P 500 returned approximately 9% compounded growth. On the contrary, if you had $383 in paper currency in 1990, the buying power of $383 would be significantly reduced due to inflation over the years. Even if you had put it in a savings account, you would have barely caught up with the rate of inflation. So, from the analysis, we understood that gold does not perform well compared to stocks. But then, why are a lot of investors investing in it? It's because the uncorrelation between stocks and gold prices. When stocks go up, gold prices fall, and when stocks go down, gold tends to go up. So if you have gold and stocks in your portfolio, your returns can get the much-needed cushion during those difficult times, saving you from suffering drawdowns. During a geopolitical crisis or uncertain global situation, gold serves as a safe haven for investors as they seek refuge from the risky assets to save their investments from the negative impacts of increased uncertainty and risks. So, an investment in gold is to just give you a peace of mind during the 30 to 50% crash that happens in other asset classes. Other than that, it doesn't really do anything. Mathematically, over a long run, you can do much better investing in the stock market or real estate. But you should have the stomach and emotional stability to ride through the 40 to 50% crashes. Now, if you really want to include gold in your portfolio, there are several ways to do it. Rather than buying physical coins or gold bars, you can invest in gold stocks, because for physical coins and gold bars, there are some extra costs involved, such as storage and selling costs. There are various companies involved in gold mining that will give you the gold exposure. When the prices of gold appreciate, you can generate higher returns because the gold mining companies benefit from higher gold prices, ultimately pushing the stock prices higher. If you do not want to spend time researching about gold mining companies and stocks, then you can buy gold ETFs. Gold ETFs are still backed by physical gold, but you do not have to worry about the storage and other costs. You can easily buy and sell with the click of a button. Gold ETFs invest in gold with the highest level of purity, 99.5%. So you are essentially investing in the purest form of gold. Also, with ETFs, you can start investing with a smaller amount, unlike physical gold, which often requires high investment. As usual, we do not recommend trading gold for the short term. There are a lot of highly leveraged gold options and CFDs available in the market. You do not have to trade any of those. It is extremely risky, and since the chance of being successful is less than 10%, it's not worth it. Consistently investing in a broad-based stock index fund has proven to build wealth for the past 100 years, and it will surely continue to build wealth for the next 100. You just have to be patient to build a big nest egg. But often when the market tanks, many investors exit in panic, and that's the main reason a lot of them lose money in the stock market. Time in the market gives you far better returns than timing the market. But if you're a type of person who cannot sleep at night thinking about your investments going south, then yeah, a little exposure to gold will not harm you. But again, it's for the long run. Like any other investment in gold also comes with some risks. Gold may not perform as well as stocks during the times of economic prosperity. It cannot give you stellar returns, but is generally a safe option if you want to preserve your capital and beat inflation. So that's all for today, guys. Hope you have gained some meaningful knowledge from this video. What do you think about gold? Will you invest in it? Post in the comment section below. And if you like this video, give us a thumbs up, as it really motivates us to create new videos. Also, subscribe to our channel to get notifications while we post a new video.